All right, well, stocks have really been off to a strong start of the year overall. The AI excitement really fueling that momentum to the upside. It's pushed the major averages to those all-time highs. Now, for investors looking to buy into this craze, there's more ways to play AI than maybe those obvious names when you're thinking Nvidia and Microsoft. Morgan Stanley out with a recent note looking at companies that are actually powering AI, calling out a few of those hidden AI gems. Joining us now, we want to bring in Stephen Bird, Morgan Stanley equity analyst, to discuss. Stephen, it's great to have you here on Yahoo Finance. So talk to us just about your thesis here, because I think a lot of investors, when they're thinking about joining in on AI, they want to get a piece of this massive rally. They're thinking of those obvious names. You're, though, looking at some of those companies that's powering AI. What's the real opportunity here for investors and why?
Yeah, thank you for having me. The opportunity really here is around the infrastructure. It's very understandable. The first port of call is Nvidia. We understand that and support that. But the infrastructure required, everything from power generation, power electronics, data centers themselves, that growth rate is set to accelerate. Many of those stocks have not participated in the rally that the first derivative AI plays really have, and that's essentially the call.
So talk to us then about your data center economics model in particular. You talk about how the cost of compute is falling. What is driving that, and what does that indicate to you about certain trends that investors should be keeping up to date with?
Yeah, I have to say, I was very surprised at the results of our assessment of data center economics. We see about a 50% drop in essentially the cost of compute, cost of computation in these data centers. That's really all NVIDIA. It's these new chips that are just much more efficient, and that's flowing through the entire ecosystem. As those costs drop, we think demand for a variety of Gen AI applications will rise, and that's essentially the thesis of our view of Gen AI adoption across many industries. That's just going to spur demand higher, and that's going to create even more demand for the infrastructure, for the nuts and bolts, all the power that's going to be required for all these data centers.
Nvidia has been dominating the AI market for a while now, surpassing even the most rosy expectations of Wall Street analysts. The stock is up more than 200% over the past year, and many investors and analysts are thinking that there's more growth still in view. With such performance, it's probably hard to think that Nvidia could be severely underestimated by investors. But in reality it is. In fact, according to analyst Kirk Materne from Evercore, Nvidia is not only underestimated by investors, but also by Wall Street itself. So, what does Materne mean by this? Let's find out. But before we dive into today's video, if you want to keep up with Tesla's latest updates, as well as other large caps, you can follow our Twitter account. We post multiple times a day about the biggest changes and catalysts in the market, so click the follow button if you don't want to miss the newest market updates. Now, back to today's video.
Taking a look at shares of Nvidia this morning, the AI chip darling, up more than 2% as Citi analysts open a 90-day upside catalyst watch on the stock. Citi sees possible supply chain commentary from chip factory and memory suppliers during earnings, and that specifically as a positive catalyst for the stock here. This is, of course, massive, as we've seen a little bit of profit taking start to emerge in Nvidia this year and early in the early innings of this year, rather. It still is a company that could very easily, by far, shoot beyond expectations that we've seen laid out on the street here. I think the street is just looking for more continued catalysts beyond what they've already seen in this earnings season will be, and stop me if we've said this before, this earnings season will be critical for NVIDIA to prove that it still has legs in growing out and capitalizing on even more demand. In the past, it's been talked about as the de facto AI play, and so just trying to cement that further from here.
Yeah, exactly. And Brad, this goes back to, it reminds me of some of the conversations that we've had with analysts, that we've had with strategists surrounding NVIDIA over the last several weeks, because you're right, we have seen a bit of an investment or a shift in sentiment when it comes to NVIDIA. The stock had fallen just around 10% from its recent high there, so there was talk just about some of that downward pressure, what exactly that could look like then for NVIDIA going forward. But Citi at least coming out saying that they see a reason to buy, at least for the short term. They are optimistic on the stock. Now, looking out, though, to the second half of 2024 this year, those year-over-year comps are going to get more more and more difficult. And obviously, it's tough to continue to post growth numbers, anything like Nvidia has posted over the last 12 to 18 months. When you talk about those tougher comps, and that's when we're going to get, I think, a little bit more of that discussion about what exactly the upside really looks like here for Nvidia. But Citi at least finding reason to be optimistic about Nvidia here in the short term. And then they also made a call out on Intel as well, which also caught my eye because Intel is a stock that's also off nearly 30% year to date. But Citi actually seeing some upside here for Intel over the next 30 days. And they're making the case that some of the selling action that they have seen, that we have seen, might be a bit overdone because a lot of that just due to fears surrounding its foundry business, what exactly the timeline looks like there in terms of how long it's going to take to really see an uptick here in sales going forward. So they're at least positive on Intel for the next 30 days and finding reason to buy.
Yeah, one of the huge kind of conversations that's continued to proliferate right now is nationalism among the chip sector.
Yeah.
Intel, AMD most recently getting hit by that. We saw that a couple days back. That is going to be interesting to see how investors factor in the international equation. And that's where it places even more of the consideration around some of the foreign relations and international business policy. That's going to become even more of a talking point as we get closer to November. Day by day, we're going to hear exactly where candidates line up on that. And that could have the potential to move some of these chip names even further here.
Evercore ISI analyst Kirk Materne thinks Wall Street isn't giving Nvidia enough credit for its vast AI ecosystem, and that claim forms the crux of his new bullish view on the stock. The analyst, who recently initiated coverage on Nvidia stock with an outperform rating and a $1,160 price target, stressed that Nvidia isn't just a chip company, but also supplies hardware and software stacks that rivals simply can't match. Interestingly, Materne's recent rating for Nvidia represents a potential upside of about 38% compared to where the stock is trading as of the time of this video, painting an amazing image for Nvidia while signaling the fact that the current dip on the stock could be a great buying opportunity for investors. Today, we're going to unpack the details of this recent rating, as well as why analysts like Materne think that Nvidia is significantly undervalued. Let's dive in. Hello everyone, and welcome back to Investocracy.
Have we shaken off any of the Uber concentration that would have kind of changed the market risks in the broadening out of the last couple weeks, month or so? Have we grown into or maybe out of our dependency on AI, or is it still potentially a major force in the market if any of these disappointments occur?
So I think AI is still a powerful force, but to the first part of your question, we seem to have at least broken the back a bit of that concentration problem that kicked in earnest last year, particularly at the midpoint of 2023. You not only had those stocks representing a record share of the S&P, you had them representing more than all the performance. And at the same time, especially in the May-June period last year, you had a record low percentage of the S&P overall that was outperforming the index, whether it was on a prior 3-month basis or a prior 6-month basis. Things have started to shift, but as of right now, over the past year, if you go back a year, look back a year, only 11% of the index, the S&P 500 index, is outperforming the overall S&P over the past 1 year. However, if you look at just over the past 1 month, it's closer to 50% of the index that's outperforming. Also, over the past month, you've got equal weight, the S&P equal weight, outperforming to a significant degree the traditional cap-weighted S&P. So we have seen a broadening out. It's been this stealth, almost corrective phase of those concentration excesses and leadership shifts toward those more traditional cyclicals like energy and materials and financials and industrials. And that's not a bad way to correct excesses, to have it occur through a process of rotation, obviously better than the bottom falling out all at once. So I think everybody would choose this type of correction of excesses versus a swift move down across the spectrum of areas.
If you thought Evercore's $1,160 price target was bullish, wait until you hear the firm's best-case scenario for the stock. In fact, Evercore said Nvidia stock could surge to $1,540 in the next year, a jump of 81% from current levels. According to the firm's Mark Lipacis, investors are underestimating the real value of the chip, hardware, and software ecosystem that Nvidia has created over the years, as well as the fact that computing eras last from 15 to 20 years and are typically dominated by a single vertically integrated ecosystem company whose returns are measured in the 100 to 1,000 bagger range. In simpler terms, the key thesis behind Lipacis' bullish call is that Nvidia is an AI ecosystem play, and it's the clear leader in a new computing platform that will drive efficiency gains for years to come. He also said that the ecosystem play typically captures 80% of the value created during its respective computing era, while other players compete for the other 20%, and he expects Nvidia to capture 80% of the parallel processing market by 2030, which could be worth more than $350 billion. If this happens, Nvidia would have an earnings power of $69 per share by the end of the decade, compared to the company generating earnings per share of approximately $12 last year. To sum up, Nvidia doesn't just sell chips, instead it builds a world around them, which is why even after a full fiscal year of more than 100% growth, the company's management, as well as the analysts at Evercore, suggest that there's more to come. If you made it this far into the video, thank you. These videos take a lot of effort and time to make, so if you enjoyed them, please hit the like button and subscribe to the channel. This goes a long way in helping us grow. That said, back to the video.
I do think that description, the rotation, the equal weight outperformance that's kicked in, the broadening out, the cyclical strength that's shown up very recently kind of gets us to that question of sort of how to describe where we're at. It seems like we're in a period of possible transition away from that deeply concentrated AI trade. What I am wondering is what we've talked about before, Lizanne, if we do depend more on cyclical type of companies, does that require either the economy to continue to surprise to the upside? Because if it's just AI, then the economy doesn't matter so much, it's disruption. But as we depend more on these other sectors, does that reassert the economy as the main variable again?
I think it does. And I think it does not just in terms of leadership of cyclicals, but that is the primary reason I think why that shift has occurred. You know, we talk about things like the Mag 7 or just concentration in mega cap techie related kind of names as AI driven. But I think there was more to the story than just that. I think those types of stocks, not specifically those 7 stocks, but that sort of concentration, that bias in performance by some of those mega cap tech and tech related names has been a force in the market really since the early part of the pandemic. And I think the reason for that is different reasons at different times. They've actually represented defense. Not typically defensive areas like utilities or consumer staples. That's what we typically think of as defensive. But I think early in the pandemic, they represented defensive kind of names because they represented the ecosystem in which we were all living when the ecosystem we were used to, day-to-day life, was shut down. Fast forward to the more recent period, like last year, that concentration in the Magnificent Seven really kicked into high gear around March of last year when we were in the throes of what we now think of as the mini banking crisis. And I think at that point, what they represented was the defensiveness associated with big liquid companies that had strong balance sheets, that didn't need the banking system, that had visibility in terms of earnings. And so I think there have been different reasons, but that's what they represented. Now we're in an environment where there's less of a focus on being defensive, however you define it, and with stronger growth, which has changed the expectations around Fed policy, that has shifted attention and leadership to those more classic cyclicals where you have that leverage to what we've seen, which is a pickup in economic growth.
Nvidia's software focus has been a game changer for the company. Data centers, which are the humming server farms that power many modern businesses, are increasingly reliant on AI. And so, by offering not just the chips, but also the software that allows these data centers to leverage AI effectively, Nvidia positions itself as a one-stop shop for the future of computing. Since Nvidia is selling the whole package, it becomes a much more attractive partner for data centers rather than just a chip supplier. And this is not just about data centers alone. there are a vast number of fields where NVIDIA's relevance will be strongly felt. For instance, NVIDIA's reach extends to other areas like self-driving cars, as its chips and software are being used to develop the complex AI systems that will one day power autonomous vehicles. Likewise, the same technology that renders explosions in video games is being used to analyze sensor data and make critical split-second decisions on the road. It's safe to admit that NVIDIA has been breaking boundaries. The chipmaker has gone far beyond merely providing the chips that run AI and has now developed processors, software, accelerators, links, and entire plug-and-play systems that take businesses from 0 to 60 in no time. Evercore's Kirk Materne points out that while 2023 was a breakout year for generative AI and early adopters jumped on the bandwagon, it's still very early in the game, and most businesses have yet to adopt this groundbreaking technology. Therefore, it's undeniable that there's much more to come for this company.
A very important name. Remember, this is a company that produces the equipment used to make chips, and they are getting nailed, as you can see there in today's trade. They reported investors clearly disappointed, bookings coming in lower than what the street was looking for. So now how do you think about kind of what to do with the stock here? And this is a matter of a lot of debate today on the street. There are skeptics questioning now with this report what this now means for 2025 sales. Is that at risk, they ask? On the other hand, Julie, bulls are going to point to the company's backlog. There's been also kind of more recent positive commentary from big ASML client, TSMC. They kind of sounded more recently positive, bullish about what's ahead. And of course, we're now, building new fabs in this country long term. That should be good for ASML as well. But clearly today, right now at least, the worry is winning.
Yeah, and it's interesting because what ASML makes is not just chip making equipment, but the most advanced chip making equipment.
The most cutting edge,
and
right.
And that's where the orders were particularly weak. ASML actually had relatively strong orders into China, where it's not allowed to sell that particularly advanced equipment. So it's still seeing that strong demand in China for the sort of not as advanced chip-making equipment. So that was sort of an interesting nuance in the report, and ASML executives seemed sort of optimistic that China demand would continue. They also said that 2024 is going to be a transition year in terms of where we are in the chip cycle. So that's something to think about as well. But keep in mind the backdrop for all of this is we're in earnings season. Tech is supposed to be where it's at. That's where the growth is supposed to come from. So is this an early sign that maybe that's going to be a disappointment? I think it's too much to extrapolate that, but it's something that investors are now thinking about. Tech leading declines here today, off by about 1.2%. So we continue to watch that sell-off unfold. And to dig a little bit more into that, let's take a look at the NASDAQ 100 here, where you see Alphabet, the only of the largest of the large cap that was higher on the day. Nvidia participating in that chip-led sell-off that was really sparked by a forecast that was read as negative by the street, and an earnings per share miss, I should say, from ASML, the big chip equipment maker. And so that's spreading through a lot of tech as well.
Recently, Nvidia stock fell sharply thanks to ASML missing its earnings targets. And it's not just Nvidia that was affected by this, but other chip makers too, like AMD and Intel, because ASML creates the tools and the machines necessary to build chips, and its weak results showed that chip companies aren't rushing to prepare for the next wave of growth. Still, ASML said that despite the first quarter's setback, it expects a rebound in the entire sector during the second quarter of the year, and this could be the case as the Fed actually get around to cutting interest rates. That's something analysts at Morgan Stanley recently said as well, pointing out that the market will potentially bottom out of earnings in quarter one, recover in the second quarter, and expand in the second half of the year. Based on that, Morgan Stanley thinks Nvidia is one of the best AI semiconductor plays to get into now. The firm recommends buying the stock before the company's next earnings report and recently raised its price target on Nvidia stock to $1,000 thanks to the potential of its upcoming Blackwell chips. You could say that Nvidia reporting earnings in May will decide everything for the company. The company's upcoming earnings will be of great interest to investors as its EPS is projected to be $5.48, reflecting a 402.7% increase from the same quarter last year. Also, the latest consensus estimate predicts the revenue to be $24.17 billion, indicating a 236% increase compared to the same quarter of the previous year. Now, it's expected that as we approach this upcoming earnings release, investors may notice recent changes to analyst estimates for Nvidia because adjustments often mirror the shifting dynamics of short-term business patterns. For Nvidia, there have been a mix of positive and negative sentiments. However, since several positive estimate revisions are still coming in, particularly because of AI, this may reflect optimism about the company's business and profitability. Investors need to accept that Nvidia is not just about gaming graphics cards and chips anymore. Rather, it's a company at the forefront of artificial intelligence, providing the hardware and software that's shaping the future of computing across various industries. It is also building the tools that will power everything from scientific breakthroughs that affect everything from the way we drive our cars to how medical professionals can perform diagnosis. As it stands, there are a ton of powerful technologies that are coming up, and Nvidia is likely going to be one of those big names that'll lead the charge. What do you think about Nvidia stock? Is it a buy at the current price? Let us know your thoughts in the comment section. And don't forget to tell us what your valuation for Nvidia is. If you would like to know what companies like Tesla and Nvidia have been up to these past few days, go ahead and click on the next video on your screen. See you there.